Okay, now let's have a look at the solvency ratios or the leverage ratio. Okay, so the leverage or gearing, sometimes guna perkataan ataupun the term gearing. Gearing ni samalah dengan leverage ratio. Refers to the use of borrowed capital for loans. So these ratios measure the level of debt in a firm. Okay, we want to know how much is the proportion of debt, okay, a company has relative to its assets. Okay, and then this ratio tells us whether the company use more debt or equity. Okay, whether the company is financing by debt, okay, whether they are issuing the bond or whether they are depending on the debt or they are issuing the equity. Okay, such as the common stock or preferred stock. Alright, and then this ratio measures the ability of the firm to service its debt obligation, and it also shows the extent of financial risk. Okay, we want to know if the debt ratio is too high, means the company has high risk. Okay, if the debt is too large. So these are the kinds of the measurement of the solvency ratio. We can calculate the debt ratio, total debt to equity ratio, long-term debt to equity ratio, and also the time interest earned. Okay, so the debt ratio. Okay, so the debt ratio shows the percentage of total debt given out by creditors. So to calculate the debt ratio, okay, we divided the total liabilities. So here, meaning to say the current liability plus the long-term liability, or all the liabilities, we divided by the total assets. So this is the debt ratio. So what is the ideal ratio? So the low ratio is favorable. So ideal suggested here for the company to has to possess 20 to 50% of the debts compared to assets. Okay, and then decision rule. Okay, too high ratio means the firm borrows too much. Okay, so it shows that the company is having high risk. Okay, next is the debt to equity ratio, DER. Alright, so this shows the portion of total debt being used to support for firms' operations relative to equity. Okay, then the higher debt to equity ratio makes the company more volatile and higher financial risk. So this is a formula to calculate the debt to equity ratio. Total liabilities we divided by the total equities. Alright, so this ratio is used to measure the company's financial leverage. Alright, and debt to equity ratio also were used to measure the capital structure of a company. Okay, it indicates what proportion of equity and long-term debts that the company is using to finance its assets. Alright, so high debt to equity ratio generally means that the company has been aggressive in financing its growth with debts. So this can result in volatile earnings as a result of the additional interest expense. Alright, so that's why it's mentioned here. Okay, if the debt to equity ratio, meaning to say the company is using more debts compared to equity to financing its operation, okay, it can be more volatile and higher financial risk to the company. So the ideal ratio is the low ratio, is more favorable, which is less than 100%. Okay. Alright, the long-term debt to equity ratio, this one is quite similar with the previous one, okay, with the debt to equity ratio. Okay, unless this one is, we calculate the long-term liabilities divided by the total equities. Alright, long-term liabilities we divided by the total equities to show the portion of long-term debts being used to support the firm's operations relative to equity. So this one also, low ratio is more favorable. Alright, so the company should on the has less than 50% using the debt, okay, to financing the operations. Okay, and then the last ratio for the solvency ratio is the time interest earned. Okay, time interest earned. Okay, this one shows the ability of the company to service debts or interest payment. Okay, show how well the company ataupun how many times the company can pay interest. Alright, so the higher ratio is favorable. Okay, higher ratio is favorable as it shows the ability to pay for interest obligations on time. So how to calculate the TIE? Okay, we divided the EBIT, earning before interest and tax, okay, with the interest expense.